0.2%. We'll get Aditi Nayar talking about that, but before that, Sunal, hi. A lot of cues that we are tracking, Pauline. Rupee, it is the WPI data that we are tracking as well. What's happening in the markets, of course, we'll discuss that in greater detail. The recovery is something we'll be tracking very closely because the Nifty is above the 26,000 mark. Let's get in Aditi Nayar, who's the chief economist at ICRA, to talk about the WPI data that just came by. It's a deflation again, but of course it's lower than what we saw in the month gone by. Aditi, is it in line with what you were expecting? And where do you think, what would the breakup look like for this one? What is the analysis suggesting?
Thank you so much. So basically, we were expecting a deflation of around 0.6% or so. So this is a little bit narrower than that. And I suspect that we may be very close to a break-even by next month, and then going into a small YOY inflation in Q4. Broadly, if we look at the cues, we've had the rupee depreciation being one of the factors that the landed prices of commodities would be on the higher side. And even, the commodity prices themselves have gone up in some cases. Crude, of course, has eased over the last couple of months, but other industrial commodities have seen a slight hardening. So I think these are some of the cues. And then, of course, food inflation is a smaller component of the WPI than it is of the CPI, but we have seen some hardening in vegetable prices as well. And that is something that we would track for the month of December.
Okay. Aditi, what is your sense in terms of how the RBI is going to read these inflation numbers as well, considering that it is in the context of a depreciating rupee?
So, a couple of different things, Ekta. First, of course, this is not the last print before the next RBI policy review. We will get one more set of data for December in January, both for the CPI and the WPI. So I think the trend continuing between October and December, that is something that the RBI will be watchful of. And in terms of the rupee, when the rupee weakens, it has a quicker and a larger transmission to the WPI than it typically does to the CPI. So I think that's something that the RBI and the MPC would keep in mind as well. The CPI has a much larger weight of food and also of services, and both these tend to be more domestically determined and have much less of a component of transmission of the rupee weakness that comes in. So I think this context needs to be kept in mind as we look at what the MPC may do in the February policy as well. And of course, just to add, there is also some element of base effects which is at play over here. And as the base effects normalize, we do expect both the CPI and the WPI to be inching upwards.
Okay, so over the next 3 to 6 months, you expect WPI to inch higher. What are some of the risks you are factoring in when you're coming to that number?
So as I said, we would expect now the WPI to be close to a break-even for the month of December, and then go into the positive territory in Q1. Earlier, we were looking at sort of average WPI inflation of around 1% in Q4. And now, depending on how the rupee evolves, the trajectory that we see over the next few weeks, we will take a call on how the impact on the WPI would be. So that is broadly what we're looking at right now. Break even by next month, average of 1%, but a trend upward basically in Q4. And an average for FY2026, which would be around 0.2% or so. Main things to look out for would be the commodity price movement, metals and crude oil, the rupee depreciation, and the impact of whether we have an sustenance of the uptrend in vegetable prices or the seasonal downtrend that we normally see in the winter months. Does that kick in soon as far as the food inflation is concerned?
Okay, we also have the trade deficit data which is due today for the month of November. I'll see what is your expectation considering that October was quite a fearful number.
Look, I'm hoping that we're going to get a much better number, somewhere around $30 billion. Couple of reasons for that. October was an aberration for two reasons. One, we had the gold imports which really surged during the festive season. So I'm really hoping that that is going to sort of normalize after October. The second, we had the festive season holidays in October. And what happens is that in the festive season, the import demand tends to be high. but the export shipments tend to be on the lower side because factories are actually shut for the holidays. So it does tend to be, whichever month Diwali falls in, tends to be like one of the worst months in the entire year for the trade deficit. And especially when we get this kind of a blowout on gold imports, I think, it was inevitable that we were going to get a number that was so bad. So I'm really hoping that November we will have the reverse coming in. Gold imports will normalize, other imports will also normalize. And with the base effect of a higher number of working days for factories, exports will look a lot better than they did in the month of October. So I'm hoping that the trade deficit will print in the vicinity of $30 billion for this month.
Okay. All right, Aditi, we're going to leave it on that note. Thanks very much for joining in and taking us through that. So, Sonal, that's going to be something that the street will be watching because it was a $41 billion record deficit that we had hit in the month of October. And we had the gold imports, which had surged nearly 200%. So let's see whether or not, that comes through in terms of a decline. Okay, all right. So we'll watch out for that big number. But for now, we'll slip into a short break. When we come back, we'll connect with the big listing of the day, management of corona remedies.